Welcome. We're here in early 2026, and we're looking at a really rare, really pivotal moment of convergence. You have these three massive investment narratives that on the surface seem totally separate, but they're coalescing, and they're forcing all of us to fundamentally rethink portfolio strategy. We're talking about the insane energy demand from AI, the binary yes or no regulatory fate of digital assets, and a macroeconomic picture that is just completely fracturing. To really get how these forces are combining, we need to start with the single most important number in this entire new landscape.
The whole thesis, really, it all begins with a physical reality check. And it's summed up in this one number, 1,000 terawatt hours. That's the projected new annual energy demand coming from AI, from data centers, and from crypto, starting this year. Now, to put that into perspective for you, that's roughly the entire annual electricity consumption of Japan. The world's third largest economy is essentially being replicated as a brand new source of power demand, and it's happening almost overnight. That's the scale of the challenge we're facing, and, as you'll see, the scale of the opportunity.
So here's how we're going to break it down today. First, we'll navigate what we're calling the macro fog. Then we'll get into the numbers on the AI energy imperative. After that, we'll look at why digital assets are really at a critical crossroads. Then we'll explore the big shift to the physical AI revolution. And finally, we'll pull it all together into a new portfolio playbook. Okay, so before we can jump into any of these specific themes, we have to understand the environment we're operating in. This entire analysis, all of it, it's taking place against a very fraught, very unstable macroeconomic backdrop. And that story, as it so often does, starts with the Federal Reserve and its current state of, let's call it, impaired visibility. The key takeaway from the latest Fed minutes can really be boiled down to two words: impaired visibility. The Fed is, for all intents and purposes, flying blind. That 43-day government shutdown late last year, it completely threw a wrench in the works, disrupting the flow of critical economic data. They missed crucial employment numbers, they missed core inflation readings, and that forced them to make these monumental policy decisions in what is basically a statistical vacuum. And all that uncertainty, it's fractured the consensus right inside the FOMC. Now, they did manage to push through a 25 basis point rate cut, which sets the new range at 3.5 to 3.75%. But the real story here isn't the cut itself, it's the split. That decision came with three very public dissenting votes. That level of internal disagreement, well, it signals some really deep policy uncertainty. And this just lays out the two camps perfectly. On one side, you've got the doves, right? They're the ones who voted for the cut. They're looking at unemployment, which has ticked up to 4.6%, and they see a serious risk of recession. But then you've got the hawks, the dissenters, and they are absolutely fixated on inflation. Their biggest fear is what they call de-anchoring inflation expectations. That's the point where you and I, the public, lose faith that prices will ever be stable again, and it just becomes a self-fulfilling prophecy. This, right here, is the definition of policy paralysis. So how did the market react to all this division? Well, it triggered a deep split, something analysts are now calling the K-shaped trade. And what that means is that one set of assets is soaring up while another is just plunging straight down, creating two completely different market realities at the exact same time. So on that plunging downward arm of the K, you had small caps. The Russell 2000 just got crushed. It fell 2.4%. And why? Because these companies live and die by floating rate debt. Just the idea that rates might stay higher for longer is absolutely devastating for their balance sheets. Meanwhile, on the soaring upward arm, you've got big tech, which was totally resilient. They have what we call fortress balance sheets, just massive piles of cash, zero reliance on short-term debt. They can pretty much ignore high rates. The crucial takeaway here is that the old Fed put, the market's belief that the Fed will always jump in to save the day, that seems to be weakening. You just can't assume anymore that the Fed is going to save the entire market. And this just sets the table perfectly. If capital is running away from all this macro uncertainty, where's it going to go? Well, it flows into undeniable structural growth stories. And right now, there is no bigger structural story than the intersection of AI and energy. This isn't just a concept anymore. It's a critical CapEx reality that's driving what could be the next trillion-dollar trade. Now, to really understand the urgency here, you have to look at the money math of this energy deficit. Back in 2022, data centers, crypto, and AI altogether used about 460 terawatt hours. I mean, that's already a huge number. But because AI demand is exponential, by this year, 2026, that figure is projected to surge past 1,000 terawatt hours. That's the demand shock we were talking about. It's like adding the entire power grid of Japan to the world. And listen, it's not just the quantity of power, it's the quality of the power. AI data centers, they need what's called 5 nines reliability. What that means is 99.999% uptime. That works out to less than 6 minutes of downtime per year. You just can't have brownouts when you're running mission-critical AI models. And intermittent sources like solar and wind, for all their benefits, simply can't provide that 24/7 baseload power. So the only scalable carbon-free source that checks that box is nuclear. And that brings us to a really concrete case study, the Eagle nuclear merger. Eagle Energy Metals is merging with a SPAC, that's a special purpose acquisition company, basically a vehicle to take private firms public, and they're forming Eagle Nuclear Energy Corp. It's expected to trade under the ticker NUC. But here's the most important detail, the institutional validation. There is a committed $30 million investment from Elisa Investment Group. That's what we call smart money validating this exact thesis. The real key to the Eagle thesis is its vertical integration. You see, this model solves the nuclear industry's historical chicken and egg problem. For years, utilities were hesitant to commit to new small modular reactors because they couldn't get a guaranteed fuel supply. And at the same time, miners wouldn't expand because they didn't have guaranteed demand from utilities. Eagle just solves both sides of the equation at once. They own the mine that produces the fuel, and they own the proprietary reactor tech that consumes it. It's brilliant. And that brings us to another key player, one whose valuation you can only really understand through this specific lens. As the saying goes, the market is pricing in criticality, not current revenue. This just perfectly explains the story of Oklo Inc. So Oklo is a pre-revenue company with a staggering $15 billion valuation. How is that even possible? It's because of what the market is calling the Altman premium. The valuation is almost entirely because it's backed by Sam Altman of OpenAI. The bet here is that Altman needs Oklo's microreactors, which are designed to be deployed right next to data centers, to literally power the next generation of AI. So it's not being valued as a utility, it's being valued as critical AI infrastructure. Okay, now let's turn to our second major theme. Happening in parallel to this whole energy story is a really binary event facing the entire digital asset class. The political attention on this is just palpable. And January 15th, that is the event horizon. So on January 15th, the Senate Banking Committee is scheduled to vote on something called the Clarity Act. This piece of legislation is designed to finally end the decade-long turf war between the SEC and the CFTC, and its core innovation is something called the maturity test. Now, if this passes, it would create a permanent legal pathway for major digital assets to transition from being securities to being commodities, which would legitimize the entire asset class for big institutions like pension funds. So how does this test actually work? Well, it's a pretty clear 3-step roadmap. An asset starts its life as a security regulated by the SEC. Then the project behind it has to prove that it's sufficiently decentralized. The key threshold here is that no single entity can control more than 20% of the supply. Once it passes that test, it legally transitions into a commodity regulated by the CFTC. This is the legal escape hatch that projects like Solana and Cardano have been waiting for years. And you can see this whole carrot and stick dynamic playing out in real time. The carrot is this increasing institutional acceptance. The SEC recently issued what's called a no-action letter, allowing the DTC, which is the heart of the entire U.S. security settlement system, to run a pilot program for tokenized securities. I mean, this could literally mean Apple stock trading on a public blockchain one day. But then, you've got the stick. New Treasury and IRS rules now require exchanges to report detailed data on any transfer over $3,000 to a private wallet. This effectively ends the era of anonymous large transfers. So while Washington is grappling with the rules for this new digital world, another, much more tangible revolution is accelerating. You know, the big takeaway from this year's Consumer Electronics Show wasn't more chatbots. It was the pivotal shift from generative AI, the software, to physical AI. This is the moment AI finally puts on its work boots and moves from just code to actual concrete. So what's driving this? Well, it really comes down to one word: physics. Physical AI? Think of a robot arm in a factory. It needs near zero latency. It cannot wait 500 milliseconds for a cloud server hundreds of miles away to send back instructions. That lag isn't just inefficient, it's downright dangerous. The critical point is this: The computation has to happen right there on the device itself. And this illustrates a massive strategic shift for investors. The past decade was all about building these huge centralized data centers, which benefited the cloud giants. But the next decade, the era of physical AI, it favors distributed computing right at the edge. The new beneficiaries here are the chip makers that specialize in low-power, high-performance chips that process data on device. We're talking about companies like ARM and Qualcomm, who are now positioned to challenge the big data center incumbents. All right, we've covered a lot of ground. We've talked about the macro instability, the energy deficit, the digital asset pivot, and the big shift to physical AI. So now, let's synthesize this. What does it all mean for your portfolio? How do we build a playbook for this new reality? The first conclusion we have to draw is a blunt one. The traditional 60-40 stock and bond portfolio is dead. It completely fails in what you might call a stagflation-light environment of sticky inflation and slowing growth. In a world where interest rates are higher for longer, both stocks and bonds get hurt. That traditional hedge just doesn't work anymore. So investors really have to look towards scarce, real assets. And we've identified 3 primary hedges for this new environment. First, you've got gold. It's the ultimate, timeless hedge against monetary policy error. Second, uranium, which has now become a direct hedge against energy insecurity, with its demand being supercharged by the completely inelastic needs of AI. And third, Bitcoin, as a potential hedge against banking system fragility. But, and this is a really critical point, its role here is heavily contingent on the successful passage of the Clarity Act. So, to sum it all up, the investment landscape of early 2026 is really defined by this necessary transition away from digital speculation and towards physical reality. The most valuable assets aren't just lines of code anymore. They are the tangible things that underpin our new economy, the physical commodities like uranium, the critical hardware like small modular reactors and edge GPUs, and the regulatory licenses that grant permission to operate in this new world. So, let's leave you with a final provocative thought here. If this demand engine for nuclear power is real, and all the data really suggests that it is, we have to start thinking about the second-order effects. I mean, the massive server farms that are needed for AI also require massive specialized cooling. So the question becomes, what non-obvious physical infrastructure beyond the energy source itself is next in line to experience the exact same kind of inelastic demand squeeze that uranium is feeling, all driven by the simple need to dissipate all of that concentrated heat? It's something to think about.